This lecture is on investment demand. The purpose of this video is to explain what motivates businesses to invest. Recall that in macroeconomics, investing means to purchase capital goods. Businesses, like every other economic entity, make decisions based upon the comparison of benefits and costs. If the benefits of taking some action outweigh the cost of that action, the business is made better off by taking the action. If the cost of taking some action outweighs the benefits of that action, the business is made worse off by taking the action. For a business firm, benefits are realized in the form of revenue, primarily from the sale of the goods and services produced. Costs are incurred primarily from payments to resources. If the revenue generated by taking some action exceeds the cost of that action, the action is profitable. If the cost of taking some action exceeds the revenue, that action will result in a loss. A firm invests by purchasing capital equipment such as tools, machinery, and buildings. A firm will invest in a piece of capital if the capital generates more revenue than it costs. But a firm never knows for sure if the purchase of capital will be profitable. The revenue will be generated in the future, and the future is uncertain. So the firm must weigh the expected revenue of the capital against the costs, most of which will be known. If the expected revenue exceeds the costs, the investment is expected to be profitable. It is the CFO, the Chief Financial Officer, who is responsible for estimating the revenue that the capital will generate. But let's look more closely at the cost of an investment. What goes into computing the cost of a piece of capital equipment? One, of course, would be the price paid for the capital. Another would be the cost of operating it. And a third would be the cost of money used to purchase the capital. The cost of money is important because the firm will often borrow money to make the purchase rather than wait until it saves up enough cash. Imagine the following hypothetical situation. There are two banks. We'll call them Bank A and Bank B. Bank A will pay its depositors 10%, and Bank B will charge 6% to borrowers. Do you see a profitable opportunity here? You could simply borrow money from Bank B at 6%, deposit it into Bank A at 10%, and your profit would be 4%. Unfortunately, there are no Bank A's that will pay 10%. But there are investment opportunities that might pay 10%. So what you could do is borrow money from Bank B at 6%, use that money to purchase this piece of capital equipment from which you would earn 10%. So once again, your profit would be 10% minus 6%, 4%. Let's talk for a moment about the concept of rate of return on investment. That 10% interest income you received from Bank A was your rate of return on investment. The rate of return on investment is the percentage increase in the value of the asset. The rate of return on investment is almost always expressed in an annualized form, so the annual rate of return on investment would be the percentage increase in the value of an asset over the period of 1 year. If you had deposited $1,000 in your savings account, and 1 year later when you withdrew it, the account was worth $1,100, your annual rate of return on investment was the new value minus the old value divided by the old value times 100, which is 10%. But how would we compute the annual rate of return on investment for that piece of capital equipment. The annual rate of return on investment for that piece of capital equipment would be computed as the annual profit from the capital equipment divided by the cost of the capital equipment, where the annual profit is the annual revenue generated by the piece of capital equipment minus the annual cost of operating it. Suppose, for example, that Acme Widget Company paid $1,000 for a new widget making machine. It would generate $5,000 in revenue per year from selling the widgets it produced. The cost of producing these widgets, including the resources such as labor, natural resources, and the depreciation on the machine was, let us say, $4,500. The annual profit would be $5,000 in revenue minus the $4,500 in cost for $500. The annual rate of return on the machine would therefore be $500 divided by $1,000, 50%. But we've omitted one very important cost that must now be considered, and that is the cost of the money used to purchase the machine. The cost of money used to buy the machine would be its opportunity cost. That is, the amount of interest the company would have been earning had it deposited the money in the bank rather than buying the piece of capital equipment. When a company uses its own cash to purchase a piece of capital, it is said to be internally financing the investment. However, most of the time, a company will finance its capital expenditures externally. That is, they will borrow the money to purchase the machine. In this case, the cost of the money would be the interest rate that the bank charges. Suppose, for example, that Acme Widget Company borrowed $5,000 from Bank B at 6% to purchase this machine. The annual rate of return on investment was 50%. Because the benefits, a 50% rate of return on investment, exceeded the cost, the 6% interest rate, the firm would find it profitable to invest in this machine. This would be exactly like borrowing money from Bank B at 6% and depositing it into Bank A at 50%. The profit would be 50% benefits minus 6% cost, 44%. Bottom line, a firm will invest in a building, a piece of equipment, a machine, or some tool if its expected rate of return on investment exceeds the interest rate. Imagine that you are the CFO for Acme Widget Company. You must report to the board of directors about the firm's capital expenditures for the upcoming fiscal year. Your task would be to consider every feasible investment opportunity facing Acme Company and its expected rate of return on investment. Then, if the expected rate of return on investment exceeded the interest rate for a particular machine or building, etc., you would suggest making the expenditure. If not, no. Now we can organize these decisions that you must make as the CFO by constructing the following diagram. On the horizontal axis, we'll measure the dollar expenditure on investment projects. And on the vertical axis, we will measure rate in percentage terms. On that axis, we'll be able to put the rate of return as well as the interest rate. On this graph, we will consider each investment opportunity available to Acme Company by use of a rectangle. The height of the rectangle will represent the expected rate of return on investment as estimated by the CFO, and the width of the rectangle will represent the cost, in dollar terms, of purchasing the capital. This first box will represent the investment opportunity with the highest expected rate of return on investment. Let's say that this box represents the purchase of a new widget making machine. The old one wore out, and this new one is more sophisticated and productive. It will cost the firm $10,000, and the CFO estimates that it will yield a 20% annual rate of return on investment. The second box represents a new computerized management system. This will permit the firm to eliminate some costly employees and thereby save it some money. The new system will cost $15,000, and the CFO expects it to generate a 16% annual rate of return on investment. We can continue to fill in the chart with other investment opportunities, and we don't have to be very specific here. Let's let this little red line represent the interest rate, and for our purposes here, we will assume that it is 14%. In this case, the firm would undertake the blue and yellow, but not the orange and green, investment projects because their expected annual rate of return on investment exceeded the interest rate. At 14%, Acme Widget Company would spend $25,000 on capital. Now let the interest rate fall to 10%. As you can see, the firm would increase its investment expenditures to $37,000. Now let's let the interest rate rise back to 14%. What would happen if businesses gained confidence in the future performance of the economy? The expected rate of return of each of these investment projects would likely rise. As a result, more investment opportunities would have an expected rate of return greater than the interest rate. Now, when the interest rate is 14%, this firm will invest $37,000 rather than $25,000. Had businesses lost confidence in the economy, for instance, they expected a recession in the near future, the heights of those bars would have gone down rather than up. In conclusion, what motivates a firm to spend on investment projects? One would be the interest rate. The lower the rate, ceteris paribus, the more investment spending will occur. And the second is business confidence in the future performance of the economy. This will affect the expected rate of return on investment.